On today's hot sheet, I'm discussing housing inventory, pending sales, and inflation. Today is Monday, October 2nd, 2023. I am Byron Lazine, and the hot sheet starts now. Okay, thank you for joining me live. If you are indeed live and not on the replay, let me know in the live chat which market you are tuning in from. We are welcoming quarter 4 2023. And I say welcoming. I see a chat here. Let's go 2024 from, I think it says Robert. I don't know if we want to wish on 2024 just yet. 2023 was the fourth largest pool of commission dollars for agents in the last 20 years. As hard as 2023 was, there was a lot of opportunity. And I want to take this quarter 4 to prepare for what could be coming for 2024. Could have, I know they've been saying the last 2 years, but could be a recession year. We already know that it's going to be an election year. 2024 offers a lot of uncertainty, and it very well may be a little bit harder than 2023. So we've got to stay prepared, stay sharp. And these next 3 months are critical to be ready for what's coming. This fourth quarter, I believe, is ultra important. For those of you that are agents, I've got a bit of news before we jump into the topics for the day, and that's coming from Redfin. Redfin has reported, I apologize there. Redfin has reported that they are leaving the National Association of Realtors. Redfin says in their own report released this morning that they are leaving NAR. Redfin is moving our end to support National Association of Realtors for 2 reasons. NAR policies requiring a fee for the buyer's agent on every listing. Now, we know that this is going to change. It's already changed in some of the biggest MLSs, but Redfin's taken the position that NAR hasn't come out and backed those changes fully. Also, number 2, a pattern of alleged sexual harassment. Since Redfin-wide initiative to join NAR in 2017, Redfin has paid more than $13 million in dues in an effort to influence NAR to advocate for an open technology-driven marketplace that would benefit consumers. Now we'll explore other ways to advance those goals. $13 million is a drop in the bucket for what NAR collects each year. That's only like 25% of their Havas marketing group budget. You can check out all of the NAR updates on the Real Word podcast that we've been doing week over week. I just thought that was pretty big news to mention to agents. Before we get into our topics, get the most out of our content by being a BAMX member. What do I mean by the most? Well, this Wednesday, we have a YouTube accountability live stream. So if you're trying to advance your YouTube game, make sure that you're in BAMX for that. And just yesterday, on October 1st, we released Lisa Chinati's course on CRM management and lead follow-up. So if you're lacking on any of those areas, plus a plethora of other content, make sure you join BAMX. You also get the downloads from this show each and every single day, all in one place. Use code HOT to get 10% off of BAMX. Use code HOT to get 10% off BAMX today. Let's jump into our inventory update as we do every single Monday. All right, Housing Wire with Altos Research has released the data here for this past week, and we did grow in active inventory. We grew more than this week last year, just not where we want to see it, which would be double digits, 10,000 or plus. The weekly inventory change from September 22nd to the 29th rose from 527,000, basically 528,000 to about 535,000. Last week, the same year, that rise was about 5,000 off of the 6,000 we saw this year. So 557K to 561K last year. We're starting to close the gap slowly but surely so that we can get out of this year-over-year negative inventory situation that we are in. The inventory peak so far for the year is right now, this 535,000 number. In 2015, we were at 1.2 million on active listings. So we're well off the peak of a normal market. New listing data. Okay. New listings have tracked the lowest ever on record the last 13 months straight. And we're not getting any more signs that that is going to stop anytime soon. New listings, while showing a little bit of a bump the last few weeks, is still below 2022 and 2021 lines. So we're not seeing new listings shoot up with where the interest rates are. Okay. So you would think that maybe, hey, interest rates being higher for longer and really being restrictive on deal flow would make more people sell. That's not the case right now. New listings still pretty low. Now, how about price cuts? This is something that Altos has been looking at more right now because it could be a leading indicator of a market that is softening and could give us some signals about what's to come in 2024. Well, this week, 38% price cut, while the same week last year was 42%. So we're still not at the same mark of last year. Last year, we saw more price cuts right now as the initial interest rate shock took place. We've been dealing with the interest rates here for the last 12 months at least 6.5 or higher. We know we're living in a world right now of 7.5. And it's still, prices are just kind of holding. People are just not willing to sell their house at a discount. It's because of how many people own their home outright, 42% being one variable, as well as how many people have an interest rate under 5%, which we've been saying 90%. So 12 months ago, 90% of people had an interest rate over or under, 5%. Well, there's some new data on that. Okay. That number is shrinking because of how many loans have been written here in the last year. Okay. So now the share of debt, of mortgage debt for mortgage holders under 5% is no longer 90%. It is now 83%. Okay. So 5% or more, you've got 17.6%, where last year was only 8.2% same time last year. 4 to 5% right now is 15.6%. 4% or less when it was 3 out of 4 mortgages is now 66%, about 2/3 of mortgages. So that's starting to shrink. The more that starts to shrink over time, I'm talking a year or 2 years, a couple of years here, you might start to see some inventory come on and some people make some moves, right? But that we're still a little bit of ways from that happening and that really adding up. But we're going to get into some inflation and recession updates here at the end of the show. Big thing for this week ahead is we've passed the government shutdown. That's going to be extended 45 days. And so we'll see how the markets react to that. Some more news on housing from the past week was from NAR. Pending home sales tumbled 7.1% in August. Okay, this is for all 4 U.S. regions, posted monthly losses and year-over-year declines in transactions. I'll be interested to see September's numbers. September seemed like a not so great market for pending sales. Let me know in your market if you saw those decline. I think really across the board from what I'm hearing and the data that I've seen so far is that September pending sales really took a slide. August showing early signs of that. Mortgage rates obviously increasing up over 7 and then pushing over 7.5 were the biggest influencer of these pending home sales taking a slide. We also have seasonality, remember. So pending home sales typically will slide this time of year. Year over year, pending transactions fell by 18.7%. An index of 100 is equal to the level of contract activity in 2001. In August, we fell to 71.8, so well below that number. Okay, the Northeast pending home sales declined 0.9% from last month to 62.6, a reduction of 18.2% from last year. The Midwest index dropped 7% to 71.3, so well below that measurement of 100, which is 2001 sales activity, down 19.1% from a year ago. The South fell 9.1% to 86.5. So the South is closer to that 100 number. They were at the 100 number just a couple of months ago. Now 86.5, dipping to 17.6 from the year prior. The West index retreated 7.7% in August to 56.3, sinking 21% from a year ago. This is what has crashed. It is transactions. We have not seen it reflect prices. In fact, we're at peak prices or above in many markets. It's something that buyers need to grapple with, right? Transactions are plummeting because affordability is at an all-time high. Less people can afford, but the home prices just have refused to move. Even with interest rates higher for longer, you would think gradually prices would come down. Now, seasonally, they always come down a little bit in the winter just based off of spring sales. So now is a good time to be shopping. Q4 is a good time to get your buyers out there and remind them that while you have high interest rates, if you're somebody that can afford, this is a moment to capitalize. As interest rates come down, these prices only get pushed up even more. I saw a tweet from RFK Jr., who's running for president of the United States. He said that he wants to have a government bond loan. Let me see if I can find this tweet. I have it saved here. I'll find it real quick. He wants to have a government bonded mortgage loan for consumers that would equal like 3.5%, something, 3%, some crazy low number, which is abnormally low. Like what happened the last couple of years, the printing money machine was abnormally low for mortgage rates. That's not like a normal way to get a home loan, right? With these low rates. Let me find the tweet. Finding the tweet from RFK Jr. 3%. Tweet by RFK Jr. Here, 30-year fixed mortgages are now already 8%. No one can afford to buy. Some people can afford to buy. We're trending 4 million home sales right now a year. Time to implement my plan of tax-free government-backed 3% mortgage bonds to make home ownership accessible again. The problem with that, okay, and this is something to educate buyers on right now, as rates come down, which they're not anytime soon, I want to be clear, I'm in the camp of they're going to be higher for longer, just face the facts. But if rates do push down to some level like 3%, you're going to see prices take off again. They're going to skyrocket again. So that's not really a recipe for a healthy healthy environment for prices and for affordability going forward. Remember, we're at the most unaffordable market we've ever seen in housing right now in September. September closed out as the most unaffordable market, beating August of 2023. So the record was just 1 month prior. All right, some good news on the overall economy last week did happen. The Fed's favorite inflation indicator on Friday rose less than expected in August. PCE, the personal consumption expenditures index, including food and energy, increased 0.1% for the month, but that was lower than the expected 0.2% for the month. On a 12-month basis, the index was up 3.9%. That was as expected. Consumer spending rose 0.4% on current dollar basis. That was down sharply from 0.9% in July. Okay, so we've got good news there on the PCE. It does appear that overall the economy is cooling. But Bloomberg reported this morning that a recession is still likely, and not only likely, but coming soon. They gave 6 reasons why. I'll go through a few of them here with you. This one is, I don't know, it's quite fascinating. This one here. So they're looking at and they're tracking how often people will or publications will mention soft landing, something that we've been talking about quite a bit. Soft landing hopes and hard landing realities. Okay, so if we go back to early 2000 during the dot-com bubble, you see this huge spike here on soft landing hopes. It's the number of news articles mentioning soft landing. you can see that from 95 to 2000, the chart is very low. If you're listening, you just got really low numbers there of number of news articles mentioning a soft landing. Once you get to 2000.com timeframe, just before we went into recession in the early 2000s, you see the number of news articles mentioning soft landing spike off the page. That's right here for those that are watching. Then this gray bar immediately after we go into US recession. Then how about in 2006, the end of 2006, beginning of 2007? You see number of news articles mentioning soft landing jump off the page again. It goes really high right before, of course, the great financial crisis and big US recession that we experienced in the 2008-2009 timeframe. Okay. Now you see a small peak here after 2010, but nowhere near those of the two previous ones. Okay, you did have this technical recession here, the COVID one, the very small gray bar. You don't really see that spike there, but a spike that is similar to the one in early 2000 and as well as in 2006 is happening right now. Number of news articles mentioning soft landing is going off the page. Of course, we don't know what's to come in 2024, but based off of the two previous spikes in news articles mentioning soft landing at this scale, just over the last 25 years, you would expect a gray bar recession coming in 2024. So that's one interesting nugget. Bloomberg argues for a recession coming this year. Now, unemployment risks skew heavily to the upside, Bloomberg argues. So they're projecting out into 2024 and suggests that there is a confidence level of unemployment rising. Now, the Fed kind of wants that because they're fighting inflation, and they're likely not to turn on the restrictive measures, according to Logan Mohtashami from Housing Wire, until they break the mid 300,000 level on unemployment. We're trending at 211,000 right now on unemployment. So that is one other signal that Bloomberg, they're talking about some of the impact on the strikes. So a lot of strikes happening across the country, whether it's motor vehicle or wholesale trade. Obviously, strikes have been in the news. All right. Now, another measurement that I thought was interesting that they're looking at. This one impacts everybody paying attention to housing. Extra savings are running out for most U.S. households. Okay. So even the top 20% of U.S. households is on a decline for savings. The middle and the bottom, every single level here is declining. Back in January of 2022, everybody was over 100 on this measurement. Okay. Now everybody is below 110. The top 20% are at 107, the middle at 98.6, and the bottom 40% of households at 92.4. This is inflation adjusted liquid assets by income group. So we're seeing extra savings now running out for every American across the board. Delinquency rates, Bloomberg argues, are low, but they've begun to tick up, and not paying attention, ignoring these leading indicators would be foolish of us. Look at even mortgage bouncing off of historically low bottom. Yes, I get it. And it's, Steve Harney always argues that foreclosures are a healthy exercise in the housing market. So there is a level of delinquencies that we want, and we're still historic low. We're at a very healthy level of delinquencies. Maybe we're even below what some would consider being a healthy level. But delinquency rates are ticking up, and the two concerning ones for me would be auto loan and credit card. Look at those going up to a level of, pre 08, 09 recession credit card, maybe even above those levels. those are concerning, that Americans are just continuing to spend as if there's a a government check coming next month. The spending is pretty significant. And here's another one, and one that you're probably feeling if you're an investor in real estate, working with investors, or even just a real estate agent helping buyers, that banks are getting strict. They're getting real strict. They're tightening the lending standards at a significantly high level. And when banks get this strict, it usually means recession. Net share of banks saying they're tightening lending standards. Large to medium-sized firms and small firms are all up over 40%. Okay. The last time we were up over 40% was at the very beginning of COVID. Okay, February, March of 2020, then it shot back down. Time before that was the 08-09 recession. Time before that was the dot-com recession. Time before that was the recession of the early 90s. The only time we get up over 40% of large, medium, and small banks all saying that they're tightening lending standards, we go into recession. So another signal that, yeah, recession is coming. So I go back to what I said at the beginning of today's hot sheet is, don't know about 2024 being something I'm rooting for. I don't anticipate rates being lower than the average of 2023 and 2024. Things usually do tighten up the couple of months leading into presidential election. The climate of, culture and politics in 2024 is going to ratchet up, unfortunately, just based off of the previous 8 to 16 years and the way we've been trending. 2024 is a tricky year. The good news is you've got 3 months, you've got quarter four to really prepare for that, to make the moves necessary, to get the support, to get on the same page with your team, with your company, so that 2024 can be one where you can grow. Because the biggest businesses in 25 and 26 are going to use 24 and this year 23, if you haven't already, to grow, to make moves, to make adjustments. The biggest businesses are typically built during these difficult times. So I'm looking at these next 3 months as an opportunity to really prepare and be ready for what could be coming in 2024. Housing, though, is not on the list for those things that could pull us into a recession. Strong housing has the Fed looking elsewhere to slow the economy, particularly the job market. So the housing market continuing to be strong is not going to be blamed for a potential recession coming in 2024. Let's take a look at where we're at heading into this week, this first week of October on the 10-year Treasury. We're still experiencing a 4.6 plus world, 4.642. We know that we've hit the highest 10-year here in the last week since 2007. Every time we've done that, over 4.5 since 1790, we've seen rates stay higher for longer. That particularly influences the 30-year fixed rate. Could be heading into a 8% world. There are some buyers that are qualifying at 8% depending on their personal situation. We did see a little bit of relief on Friday when we ended the week on the daily survey at 7.44, down from 7.6 the day earlier. Last week's weekly survey, we were at 7.31, the highest since the year 2000 on the weekly survey. We've also hit the high last week on the daily survey, being 7.65 since the year 2000. All right. There you go on your hot sheet. Get the most out of BAM by joining BAMX. Use code HOT to get 10% off. This Wednesday, we have a YouTube accountability group. For those that are looking to grow their YouTube channel, maybe take some of the data that we download every day in BAMX here on the hot sheet, like the charts shared today, and use that in your local show. YouTube accountability group would be a great thing. You got to be a BAMX member to be a part of that. That kicks off this Wednesday. Lisa Chinati's course on CRM and follow-up launched yesterday. We release new courses and content every single month in BAMX, where we actually show you how to do it and don't just pontificate like many others. Use code HOT to get 10% off of that. I'll see you guys back here tomorrow on the Hot Sheet. Have a great start to your week and a great start to quarter four. Till tomorrow, toodaloo.